Ladies and gentlemen, good day and welcome to Antony Waste Handling Cell Limited Q3 and 9 months FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. N.G. Subramanian, Group CFO. Thank you, and over to you, sir.
Thank you. Good afternoon and a very warm welcome to everyone present on the call. Along with me, I have Mr. Mahendra Anantula, Group President, Operations, Business Development and Diversification, and SGA, our Investor Relations Advisors. Our investor presentation is now available on the stock exchanges and also on the company's website. First, I would like to provide some business update. The essential nature of our service, our diverse customer base and recurring revenue streams provide stability to the business. And over a period of time, this has also proved right and comfortable for us. A word on the macro aspect, keeping pace with the green energy focus of the world and reducing its carbon intensity, India has planned big for the green energy sector in its financial budget. The government announced a slew of measures for the initiatives related to the green fuel, green mobility, green buildings, and even green equipment. The budget further provides for India's government to provide incentives to urban civic bodies to improve their finances and creditworthiness and help them raise funds through municipal bonds. Attempts through property tax, governance reforms, and ring-fencing user charges on urban infrastructure will enable cities to improve their creditworthiness for municipal bonds. These are very good positive news for the sector at large. Also, since India has an ongoing G20 presidency, its focus on these parameters bodes well for us. On the quarter's performance, the nature of our services and our diverse customer base has helped us to provide a stable revenue line, and this is reflected in the company's reporting a year-on-year 6% growth in its operating revenue at 158 crores in the third quarter. This growth being driven partly by organic volumes growth in waste processing, along with the steady state of operations in our C&D operations, and also aided to some extent by the new Nashik C&D project, which started operations in December 2022. On the MSW C&D project side, we currently have 16 ongoing projects. The C&D business volumes remain flat on a year-on-year basis at 0.4 million tons in third quarter. And as mentioned earlier, our new Nashik C&D has started operations in December 22. This will add to the volumes growth going forward. Coming to the MSW processing side, the total tonnage processed during the quarter increased by 7% to 0.64 million tons at our MSW processing projects, which included Kanjur, Pimpri-Chinchwad, and the Greater Noida biomining project. An update on the waste-to-energy plant at Pimpri-Chinchwad, the project is on track and we expect the operations to start in Q1 of the next financial year. We would also like to address the key point which has underlined this quarter's performance. As you are aware, we work with a lot of municipalities and government agencies in over 14 municipalities to provide integrated solid waste management solutions. This sometimes increases our receivables challenges. The company, under its guidance of its board, has initiated a process of creating a receivable reserve to reflect the nature of our business, which is aimed at providing comfort to the balance sheets and some cushion thereof. We have initiated this process by creating a reserve of 14.2 crores in the quarter. As we go along, we hope to refine this receivable reserve calculation based on historical track record of managing receivables and adopting a credit default study in this limited space. On a reported basis, the EBITDA is down at 15.4% margin as compared to 21.9% for the same period last year. But on an adjusted front, which is considering only core revenues and excluding index adjustments and this expected credit loss provisioning, the adjusted EBITDA for the quarter would have been 24.8% as compared to 26.3%, reflecting an almost steady run margin trend. And for more color and on the operations and business outlook, let me invite Mahendra to take over. Mahendra has over 30 years of experience in the urban infrastructure and waste management sector, with extensive experience in the areas of corporate strategy, project development, sales, and consulting the waste and water urban infrastructure. Prior to Antony, he was with Suez, where he had played a strong role in the development of the company's operations. Traditionally, which was purely focused on metropolitan cities, it is now diversified geographically and works also in Tier 1 and Tier 2 cities in India.
Thank you, AJ, for the introduction, and good afternoon to all. At Antony Waste, the business and strategy have been to be the best in C&T and MSW processing sections, and this is exactly what is reflected in the steady growth of our operations over the years. Not to talk about the various contracts that the company has bagged in the due course. Going forward as well, Antony Waste intends to achieve high level of circularity in waste management and create a strong sustainable model. The company is also evaluating strategies to de-risk the business by adding more non-municipal revenue streams. For achieving this, the company has created a strong team to explore the ancillary waste management businesses like the one which the company has bagged recently, in fact last week, namely the processing of construction and demolition waste in Mumbai city. This is a new business segment that we have added in our portfolio. We are happy to let you all know about the details of the significant order, which includes collection, transportation, processing, and disposal of construction and demolition waste in Mumbai city of 600 tons per day. This 20-year concession contract with BMC is worth 1,024 crores, that's little over 1,000 crores over the 20-year concession period. The sustainable material recovery approach is planned to be used here, which identifies specific C&D materials as commodities that can be reused in new construction projects. This is our first order in this category, and that's why it's a big breakthrough for us. Having said this, such repeat or multiple orders are testimony to the confidence our clients have in us. We have a head start because we are an integrated solid waste management company and building a strong track record for the future. Our endeavors to implement a circular economy-based process will continue with our emphasis on increasing our sale of RDF, compost, concrete, sand aggregates, and so on and so forth. Talking a bit more about the circular economy and creating sustainable living conditions for the citizens in the cities that we operate, we started a recycling business in Varanasi from the waste collected there since last one quarter. In this third quarter of the year, the recycling activity has been going well, and the company has effectively recycled about 100 tons at its Varanasi site, preventing this waste from ending up in a local landfill. This is over and above our scope defined by the Nagar Nigam, and we are very pleased with the rate at which the project is progressing. We intend to do similar projects in all cities where the company has C&T operations. In addition, keeping with our cluster-focused business approach, the company bagged a 7-year mechanical power sweeping contract from the Pimpri-Chinchwad Municipal Corporation, a city where we already have an ongoing waste-to-energy and a collection and transportation contract. So in this, this power sweeping contract calls for the supply of 4 power sweeping machines and the daily maintenance of about 160 kilometers of road length. During the quarter, the biomining activities of our Kanjurmarg integrated waste processing site have progressed very well. Due to the high calorific value of our RDF, demand has been strong, resulting in record RDF sales of over 15,000 tons during the quarter. This trend is looking up based on the response we are getting from our clients. And to more on the financial aspect, I will ask NG to take over from here. NG, over to you.
Thanks, Mahendra. Let me share the highlights of our financial performance. For the third quarter of the financial year ending March 2023, the performance on a consolidated basis, the operating revenue front, the revenue has increased by 6% to 158 crores as against 148 crores in the same period last year. For the 9-month period, the operating revenue stands at 474 crores up 12% on a YOY basis as against 422 crores for the same period last year. Increased volumes in both processing and CNT services as well as price escalations has helped drive the part of the increase in core revenue. And as mentioned earlier, our Nashik CNT project has contributed only for 1 month of the last quarter. On the consolidated EBITDA front, the company has registered a degrowth of 5% to 34 crores in Q3 FY23 compared to 36 crores in Q3 FY22, with an EBITDA margin being 15.4%. As mentioned at the beginning of the call, if I were to look at adjusted core EBITDA, which is excluding Ind AS and ECL provisioning, the consolidated EBITDA would stand at 24.8% and compares against 26.3% for the same period last year. In absolute terms, the adjusted core EBITDA would have been 44 crores as compared to 42 crores in Q3 22. For the 9-month period ending December 22, the consolidated EBITDA has registered a growth of 7% to 129 crores compared to 120 crores for the same period last year. The profit before taxes for the quarter stood at 19 crores as against 23 crores same period last year, and for 9 months it was 84 crores versus 79 crores for the same period last year. Profit after taxes is at 16 versus 19, and for the 9-month period it's 72 versus 65. On the balance sheet side, our net debt to equity as of 31st December 22 was maintained at 0.4x. The total debt as of 31st December 22 stood at 342 crores and net debt is at 254 crores. The average consolidated borrowing cost for the company for the period ending December 22 stands at 9.7%. Our receivable days as of December 31 stands at 61 days, which if adjusted for the ECL provisioning would still be around 66 days, still better on a sequential basis. That's from our end. Now we can open the floor for Q&A.
So should we start the floor for Q&A? Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask may press star and 1. The first question is from the line of Faisal Hawa from HG Hawa & Company. Please go ahead.
So, sir, am I to understand that this 13 to 14 crores other expenses increase is due to a provisioning that we have put for debtors, which may default in future? So, is that the right way to understand? And or is it that we have already, we have lost the money and it will not be coming? So that's one. Second is, sir, in this construction processing contract that we have, do you see a possibility of also processing the materials that we collect as waste and making some end products out of it? And if yes, what is the revenue potential for those end products? Third is what the Union Finance Minister Nirmala Sitharaman also mentioned in a press conference that a lot of Mumbai's high AQI is because of the waste and the methane gas being released from the dumping yard. So this may become a very big issue in the future. How is the company addressing it so that before it becomes a large press issue, we are able to process this methane gas and also the waste on a very war footing before something untoward, God forbid, happens. And fourth is, sir, where do we stand on the vehicle scrappage policy? Is there something in the budget for us? And are we going to now go forward with it?
Thank you, Mr. Hawa. Let me take the first part, and then then Mahendra can step in for the balance 3 points. Given the nature of our work, which though is essential in nature, there is always a time delay in realizing the funds from few of our clients. The company has, after a detailed internal due diligence, initiated a process of creating a receivables reserve, which is in the nature of expected credit loss, aimed at providing for probable delays in receivables So what we are saying is this 14.2 crores is not a write-off, it's just a conservative approach of provisioning this money. Now the reason that has led to us arriving this number is primarily due to factors like delay in getting work orders, delay in getting approval for the work order, delays in getting interdepartmental approvals for bill processing, and release of funds from pre-agreed or central channels. So these are factors which is beyond the company's control or stuck in bureaucratic timelines. So the company has actually gone ahead and kind of factored this. That's a time delay of releasing the funds, so let us make a provision. These are not write-offs. Let me repeat that. These are basically, I was expecting funds to be released in a particular time zone. This is now getting stretched out, so that is why I'm making a provision. These are not write-offs, and we expect to realize this in the forthcoming time. On the other points,
Mr. Hawa, you asked about the C&D contract. So the revenue that we talked about 1,000 odd crores, is only from the tipping fees that we are supposed to get from the client. The revenue from the sales, of course, to answer your question directly, I mean, yes, the project is about collection and transportation of C&D waste, plus processing into saleable products like sand aggregates, paver blocks, concrete, and so on. So the 1,000 odd crores is only from the tipping fees. The revenue from the processing of this thing is something that is going to be an upside. Okay.
No, but what will be the revenue that we are expecting in processing this waste? And is there a plan for it?
This is what, yeah. So we have done a decent study, I mean, of this segment. What we have figured out is that this is a new segment that we are trying to create. As of now, we feel in the coming years, in the next 1 or 2 years, the revenue from this should be about add to another maybe 10% odd. Although going forward, the future is very bright.
So 10%
in the next
of what?
couple of years, you can expect about 10% additional revenue from this end product sale.
10% of the total turnover of Antony? Or 10% of the C&D contract?
So for example, let's say in a particular year, our revenue from tipping fees is 100 crores, so we can get maybe another 10 crores from sale of finished products, processed.
So, but that 10 crores would be very margin accretive.
So it is marginal. That's what I started by saying. It's marginal for the time being, but the demand is picking up, and going forward, we expect it to go up. I mean, today we cannot give you a number in terms of how it will be, how much will it be in the next 5 years. But in the next 1 or 2 years, we expect it to be definitely more than 10%. Additional 10% from what we have reported. And so our feasibility of the project when we bid also is only on the basis of revenue from processing fee. So that's purely an upside. Okay, so on your question of vehicle scrapping business, I mean, that's a very interesting question. I mean, this is something this is a subject which is very close to our heart. We have made decent progress, and by the end of this financial year, definitely we should be in a very, very advanced stage of announcing to the market about our first vehicle scrapping facility, the revenue from which we expect to accrue from FY23 onwards.
So we will announce in the next financial year and or this financial year.
So let's say in a year from now, that is maybe January, February 24, we'll be announcing our plan, and then we'll be implementing it, followed by revenue accrual from maybe March, maybe June or July of FY of 2024.
So, about my question of the waste and the methane gas really affecting the AQI of the city. So my pointed question is that if God forbid any untoward incident happens, and then we get blamed for it, it could put the entire business at risk. So are we taking any ball-putting steps to really address this before any kind of press coverage or negative feedback comes in?
So Mr. Hawa, in the landfill that we operate, which is basically the Kanjur facility, we have a mechanism wherein we extract the methane and we generate power out of it. So the buildup of methane and that leading to the event that we have seen in Deonar is not a possibility at our site. But problem lies with other landfills which are not treated. They are actually dumping grounds. So what you are saying is very true, but in the sites that is controlled and operated by Antony Waste Group, this is not an issue because we are tapping the methane, we are extracting it, and we are generating power out of the same.
Okay, thanks a lot for answering my questions so well.
Sure, thanks.
Thank you. The next question is from the line of Nirav Dalal from Maybank IBG Research. Please go ahead.
Thank you for the opportunity. A couple of questions. First, on the construction and demolition waste contract. So,
Mr. Dalal, sorry to interrupt you.
Yeah.
Please.
Now is it visible? Now is it audible?
Yes, sir. Thank you.
Yeah. Okay. So this is regarding the C&D waste contract from Mumbai City for 600 tons per day. Just wanted to understand how will be the revenue trajectory of this. We're talking about 1146 crores over 20 years. So would it be equal, or I believe this would be based on the tonnage that we pick up every day. So if some information in terms of how the revenue recognition here will happen. And a related question would be what would be the capex requirements for this contract, and going ahead as we look at processing of this waste. So what are the capex requirements here? Where will it be done, and things on that?
Right. So thanks for your question. As for the CND, the investment is for this project, the capex requirement for this project is about 60 odd crores, which is what we'll be doing for both the components, CND module as well as the processing plant. Both of that we will be implementing in the year one itself. Okay, and as far as the revenue is concerned, as I explained earlier, that the primary revenue stream for us is the tipping fees. So 600 tons per day times the tipping rate is what will be the revenue. And as per the contract, we are entitled for an annual escalation.
Okay.
So that will further add. So two things will increase the future revenue. One is the organic growth of the quantity, the tonnage, and the escalated tipping fee.
Yeah. So just sticking to this, the 600 tons would be the optimum weight, optimum waste that we would be carrying, right? So it will be gradual over the period.
So 600 TPD is actually the client's estimate as per the tender, and even the small dipstick study that we did at the time of bidding. I mean, we have no reasons to believe that it will be significantly higher or lower than 600 TPD. So for the time being, we can continue with 600 TPD as a number to assume our future revenue projection for year one.
Correct. And the revenues would start from next year. How should one look at from the April-June quarter, or how should one look at this?
So Nirav, we have a mobilization period of 12 months, one. And second is the construction debris activity normally is seasonal in nature. So during the months of monsoon, the C&D activity kind of drops, and then it picks up during the festival season and the dry season. So this 600 TPD is an approximate number over a period of time, one, for the financial year, for example, 12 months period. And secondly, the tender also allows us to plan for a 20 to 25% excess to be managed. So the facility would be in place to process 600 tons per day plus 25%, but the daily tonnage will swing depending upon the market conditions and the seasonal factors.
Correct. And just very quickly on staying on this, so the builders or the sites, so you would be contacting them, or how will this work happen, because there will be multiple sites across.
So normally what happens in this section is each local ward officer, so when a building is getting redeveloped or anything, they need to get the local ward office approval. Then that's how the process of flow of information will happen, where in a particular ward, the ward officer in charge of redevelopment the builder gets in touch with such people, and they kind of make an estimate of the total tonnages that's likely to become, and they make the builder get in touch with us, and we are supposed to pick up the waste, weigh it as a weighbridge, and give a certificate that this is the tonnage that has been shipped from that particular site. So that's how he clears his dues, he clears his responsibilities.
Okay.
So if there is any, any excess or deficiency, he needs to be answered to the corporation based on the estimates.
Got that. And just generally in terms of the contracting, how is the visibility that you have? What are the number of contracts that you have bid for? And in the C&D, what more are you looking at? Are there other regions where such similar contracts are coming out?
There are a few projects in the pipeline. They're still in the drawing board stage in a lot of cities, but most of the metropolitan cities are the first one to be off the block. They are contemplating tenders.
So that's on the C&D, but generally in terms of our C&T business waste.
So the C&T business, notably I would point out two specific tenders which are, which some of our tenders are coming to an end. So those definitely are going to come up. Those are the ones which are our first priority in terms of focus areas. But then apart from that, there are a few more cities, especially in the south zone, that we are trying to target.
Got that.
Today we cannot talk about specific cities, but broadly I can say something in the south zone is looking promising.
Got that. I'll come back in the queue if I have more questions. Thank you.
Thank you. The next question is from the line of Dikshit Doshi from Whitestone Financial Advisors. Please go ahead.
Good evening and thanks for the opportunity. Sir, I have a question on our slide number 22 of the presentation. Just wanted to understand about the accounting. So if I go on to slide 22, the current quarter EBITDA you have mentioned is around 34.3 crore. If I add back the provisions which we have done is 14 crore, so the EBITDA could be 48 crore, and our core EBITDA is 30 crore. So is my understanding right that the project business have the EBITDA of 18.6 crore?
So no, so the core. The Ind AS accounting part, the contract and others also includes revenue from power sweeping and sale of RDF and scrap over there. So this would not be the right way of looking at it because there's a decent amount of money sticking there. So I would say of the contract and others of 64.6 crores of revenue line, around 48 crores would be my contract revenue purely. The balance being my sale of RDF, sale of compost and sale of scrap and revenue from my power sweeping contracts.
Okay, and similarly for the 9 months, how much it would be out of 192 crore?
I would say it would be around 168 crores would be my contract revenue.
168 crore. Okay, so for 9 months, there would be an EBITDA of around 30 crore from the project.
For 9 months, yes, because the EBITDA margins in my project revenue is basically a book entry that we have, which is calculated as a project IR of around 10.2%. So it's just a number that we plug in based on the capex that we have done for the Pimpri-Chinchwad and the Kanjur projects.
Okay, so just to understand, so let's say once this project starts, from next year onwards, let's say the project revenue will not be there. So this
right.
This 30 crore EBITDA will no longer be there from next year.
Right. So what happens is that from the contract section, the revenue goes off, the project expenses also goes off. One. Second is then you'll see the revenue from core operations starting, and that will add to my MSW processing line item. So what you see at 129.7 crores, that will increase by the processing component which is going to come from those sides.
Okay. Now, just to understand, so currently we have 4 projects, I think, which are going to come up. One is PCMC, Nasik has already started. Something in Kanjur Marg and NDMC also, right?
Sorry, can you repeat that question, please?
So I think 4 new projects are going to give us the revenue from, let's say, this quarter or next year. So one is PCMC, the Pimpri-Chinchwad. The second is Nasik, which already has started. Then something is going to come from NDMC and Kanjurmarg as well.
The first 3 points are right. We have incremental revenue coming from Nasik, the incremental revenue from PCMC's waste to energy in the next year, and the NDMC contract will be ramped up completely, which is actually ramped up from February 15th onwards. So we should be having that completely in our place. The Kanjur facility would be part of my enhanced processing of fresh waste. So it's an ongoing project that's not going to be incremental revenue significantly from my tipping fee section, but there will be incremental sale of RDF and compost. But having said that, these sale of byproducts, they don't enjoy the same margins that I have in my processing side.
Okay. And can you just give me the, let's say once all these projects start, the annual revenue potential from PCMC, Nasik and NDMC?
We normally don't comment about site-specific numbers, but it would be fair to assume that the annualized number on a steady state of affairs based on budgetary allocation from the corporations, we would be looking at around 80 to 95 crores annualized contribution comfortably. I mean, I'm not even including NDMCs at 100% steam. So once NDMC starts, that itself will contribute around 95 crores of revenue. So we should be knocking up around 130, 140 crores of revenue on that side. And these are conservative numbers over here.
Okay, and so just to conclude, so Nasik has already started, PCMC you said from Q1 FY24, and NDMC from when?
NDMC should start from February. We already scaled up our entire site. We are pending confirmation from the client to confirm the same. So once that is done, we will have 100% sign off on that part. And your Kanjurmarg will have incremental revenue from sale of RDF and compost. Again, these are all seasonal elements. So that will come in as and when it comes.
Okay. Now, one more question on this PCMC project, Pune project. So I was just going through our past Concall. So just to understand, so the capex for this Pune project is 250 crore, of which approx 50 crore we will be getting the grant, and 110 crore we will be taking debt, and let's say 40-50 crore would be through internal accruals. And it was mentioned that this can generate 65 crore of peak revenue top line, and if I assume let's say 40% EBITDA margin also, then it's around 25 crore EBITDA with around 10 crore of amortization and 10 crore of interest. Then we will be hardly earning like 4-5 crore. So the ROE will be in the single digit in this project. Is it a fair understanding?
Mr. Doshi, there are two assumptions that can improve on the current. The numbers that we are saying is based on very conservative system. Antony has never executed a waste to energy project in its lifetime. So we have been very conservative and trying to be safe so that we at least cover our base numbers and cost. One. Second is the PLF that we have assumed when we are arriving at the revenue line is around 75% PLF. Going by the track record that we have seen in similar plants set up by Hitachi, it can be as high as 85 and it can even touch 95% during the parts of the project life. Third, more importantly, there is also a tipping fee component which is linked to the escalation. So if, over the last 2 years, we have seen a significant spike in the cost of fuel and labor cost. So that will also add to our top line a bit. So these are the three positive factors which can improve the return dynamics. But yes, point is why did we bid so competitively is something that we wanted to work with a client who is strong, who pays you on time. The revenue is ring fence. My exposure to the state electricity boards are zero. My client pays me, which is Pimpri Chinchwad Municipal Corporation pays my revenue. So these are the conditions that we took in forward. The capex is something which we didn't negotiate and compromise on. So we went with Hitachi, Johnson and Eastech. So we are paying top dollar for the capex. So the return that you are saying is for not taking any risk here. Going forward, this will improve when we are able to indigenize certain parts of the construction and we are able to understand the dynamics of running a waste to energy plant. Today, we don't want to compromise on quality and on serviceability, and we don't want to take chances here. So these are the numbers. That is what we have on the drawing book today. But we will revisit this once the plan starts.
Okay. And just last one question. After this provision, how much would be currently more than 1 year old receivable?
I think currently more than 1 year old receivables would be less than around 40 odd crores, but these are all due as and when the project closure happens. So the tendering terms clearly state there is a retention money which is retained by the client and released at the end of the project life. So those would be more than 1 year, which is the case with most of our contracts in this scenario.
Let's say out of 40 crore, if we exclude the retention money, then the disputed amount or the delayed payment would
be just 8 crores.
8 crore.
Yeah.
Okay. Okay, that's it from my side. Thanks.
Yeah.
Thank you. The next question is from the line of Manav Vijay from Deep Financial Consultants. Please go ahead.
Yes, thank you very much, sir. Sir, first of all, on the provision that we have made of around 14 crores or so, if you can tell us in our history so far, how much amount we have written off?
So we have not written off any money historically. These are the dues which is delayed for us because there are changes in the administrators. So in most of the corporations, let it be the BMC, Nagpur, Pimpri Chinchwad, or even Navi Mumbai, Thane for example, Delhi. I mean, we don't have standing committees at these places which can pass the budgetary approvals, which can vote on these norms. So there is a delay because the very structure of organization is not there. So unless the standing committee is elected and they are able to vote and pass the budgetary spend, these things are getting delayed, and that is the reason why we have taken a provision. So we have not taken any write-offs. These are getting delayed for factors which neither the people in control of the corporation are able to do it, nor is the company able to swing it because the people who are supposed to approve these documents are not in place.
Okay. And going forward, should we factor in any more provisions, or this is, or should we consider this 14 crores as one-off?
So this was discussed in our board multiple times to have a methodology to approach this expected credit loss, as we call it. I mean, that is, in the past we were very client specific, very project specific, but that is not the right way when you're looking at multiple clients. We have around 19 municipal corporations that we work, so we need to adopt a methodology. So we are looking at an actuarial study to be done in this aspect, especially in the absence of a probability of default risk of municipalities in this area. We are not able to come out with a clear plan, but we are reaching out to experts so we can quantify this. Maybe a percentage or a half a percentage of the revenue should be set aside. That is something that we are talking about. But how to arrive at that ratio is something that we are looking at experts to provide that data to us. So what we understand today is based on our reading, this delay is a one-time thing. Never in the history of a BMC, for example, in the last 180 years of its existence, has the budget been passed by the administrator alone. So this is only twice in its history that's happened. I mean, similarly, these kind of events we don't expect to repeat frequently. So we believe this could be a one-off thing, but we will keep revisiting this, whether we need to rationalize this, where we need to quantify this, where we need to have a study to prove this, and have a methodology to support us.
Okay, fair enough. Now, sir, moving to the next question of basically this new project that we have got of C&D. So now the processing of this waste will be happening at the Kanjur Marg, or the BMC is going to give you another piece of land for this?
No, this is not at the Kanjur Marg. This is going to be a different site.
This is entirely in the western zone. So we will be locating a space in the western zone, the western suburb area, where this processing will be taken care of. It will be away from the residential zones.
Okay. Okay. And And when basically BMC released this contract, so was it only one single contract of 600 TPD, or there were actually multiple contracts, and actually Antony got only one contract?
There were two packages. One was for the western suburbs, the other one was the eastern suburbs. We bid for both. We won the western suburbs.
Okay.
So there were
possible to share who got the eastern suburb project?
I'm sorry?
Possible to share the name of the company who got the eastern zone project?
Metro.
Metro Waste.
It's a Delhi-based company called Metro Waste.
Okay. Fair enough. My next question is, sir, on the NDMC project that we had won last year. So now you just mentioned that from the month of February, I would say from this month only, the full ramp up will happen. And it was close to 1,000 crore project for a 10-year. So from quarter one onwards, or let's say for FY24, we should build a revenue of around 95 to 100 crores.
Yeah, that will be a safe assumption, because part of the capex was supposed to be procured by the corporation and handed over to us. So there was a time delay over that part. And once the entire assets have been given, we have also built our required asset base. So we have already communicated to the client that these are in place, so please allow us to grant the COD. So we believe we should be in a position to ramp up the entire facility officially from the month of February onwards.
Okay. My last question to you, sir. So every con call we talk about almost a 20 to 25% kind of a sales growth every year. So the variation in the quarter can certainly happen. Now this year in 9 months, we are running very low in terms of the sales growth. I think we have some 5-6% kind of a growth is what we have been able to do. X of the contract revenue. Now you believe that quarter 4 you will be in a position to catch up, or you will fall short?
So we never told that we will be growing at 25% year on year every year. We told about 25% CAGR growth, because the nature of business that we have, the growth is lumpy. And for the 9-month period, we are already reporting a core revenue growth of 12%. It's not 8% or less than 1. And second is, over the last 3 quarters, the company has been bagging contracts. Let it be the power sweeping contracts in Pimpri-Chinchwad or the Nagpur, and now the C&D contract. So the company has been bagging contracts. Now, the nature of business is it takes us almost 6 to 9 months or even a year to mobilize the asset and start reporting the revenue. So the time of bagging the contract or signing an LOA and the revenue recognition is a time part of it. So we are still confident of reporting a CAGR growth of 25% over 3 to 4 years. It is not going to happen 25% year on year. It will be a lumpy growth. It will be a staggered growth, more of a step-up growth. It's not a linear growth for us.
I think you should probably look at the way the EPC companies or the construction companies work at. They are dependent on these government tenders, and there are many years when there are hardly any tenders, and then comes a time when the market is full of tenders. So the EPC companies win a lot of contracts, and which has a cascading effect on the future revenue in a few years down the line when they start including those contracts. So we are in a similar business, dependent on the government for the tenders, because of the multiple reasons which you are probably aware of. Projects often get delayed, but sooner or later they happen, and that's how our growth is never a smooth curve.
Sure. Thank you, and all the best, sir. Thank you very much.
Thank you. The next question is from the line of Richard D'Souza from SBI Mutual Fund. Please go ahead.
Yeah, good afternoon.
Good afternoon, Richard.
Am I audible?
Yeah. Slightly weak.
So your audio is slightly muffled. Please use the handset mode.
Just a minute. Is this better?
Please go ahead.
Hello.
Hi, Richard.
Yeah, hi. Just a couple of questions from my side. One is you were talking of those provisions for of about 14 crores. Just a bookkeeping question, what was the exact provision for the third quarter? Because you're mentioning it both for 14 and for the quarter and the 9 months.
The entire amount of 14.2 is for Q3. It's not over Q1 and Q2 and Q3. It's only for Q3.
Okay, it's only for Q3 because your statement in the presentation was saying it was for Q3 and for 9 months. So I thought, this 14 was for 9 months kind of a thing. Yeah. And even if we strip that off and, calculate your core operating margins, your core operating margins seem to be under pressure. Now, why is that the case? While your revenues have been growing at a handsome clip, but your margins seem to be under pressure. Is my understanding right?
Two factors that has led to that, Richard. There's a margin fall year-on-year basis on core operating section by around 160 odd bips. The two factors being the higher transportation cost associated with shipment of RDF from our Kanjur site. And second is we have kind of written off all our startup expenses at the Nashik project. Since the Nashik project started in the last month of the third quarter, instead of capitalizing and trying to make it like a deferred revenue expenditure, we kind of wrote it off completely. And most of the cement companies are almost 400 to 800 kilometers away from the Kanjur site. So the initial part of the RDF sale, the transportation has a higher chunk of the cost, and it's been a neutral to a negative EBITDA business in the past, but things are improving now.
Yeah, also, especially for the RDF business, I mean, we are in the growth phase. We are actually trying to make sure the cement companies actually get used to our RDF and switch over from conventional coal to RDF on a sustainable basis. So this has been, especially this year, had been the phase for, and probably even the next year, we'll have to spend a lot of time and energy and patience on acquiring customers.
Yeah, but just to play the devil's advocate, I mean, RDF as an alternative fuel for cement companies seems to be quite profitable for them because the energy cost had gone up quite a bit. But what you are saying is that they are not willing to bear the increased transportation cost or anything like that, though it is beneficial for them.
I mean, that's true. I mean, the cost of coal definitely has gone up and so on. But it so happened that the cement companies are very, very tough guys to negotiate with. And so while they are, negotiating with us, they are negotiating hard. Okay, so they're not easy to give us a high rate just because the coal prices have gone up. So it's a never-ending battle. I mean, we will continue but the good thing is that as compared to last year, our net realization per ton of RDF has gone up significantly. Mm-hmm. That's a positive sign.
Okay.
Yeah, and to add to that, Richard, historically what has happened is the cement companies were receiving RDF. It was more like a wet mixed garbage, which has not gone well with most of the cement companies. So they're very skeptical about the quality and the sustainability of the supply of RDF. So that has been one of the main concerns in the past, which we over the last 3 quarters, have been able to address them by consistently supplying them well shredded and relatively less damp RDF, which is what has been a positive for us. So as Mahendra was saying, from a significant negative zone, we are now not only in the neutral but in a positive zone when it comes to pricing for the company.
Yeah, so and also to add, so one of the things that we are now talking to cement companies about is to benchmark the calorific value of RDF vis-a-vis the coal. So on the thermal equivalent, so we are trying to price our product on thermal equivalent basis. So that's the strategy that we want to adopt and going forward.
Okay. So just to break this 160 bits further, I mean, what would you attribute it to this increased transportation cost and what would be the write-off of startup expenses?
So I would say bulk of this impact would be my transportation cost, because I have actually would be around more than 150 bips would be my hit from transportation. The startup cost of Nashik it's not as significant as my transportation cost. The third quarter we saw a record shipment of RDS, which we couldn't budget in our plan, so we couldn't have tie-ups with the appropriate logistics end to supply 15,000 tons so that we could benefit from the pricing.
Okay. And one last question from me. There have been talks basically of some large contracts coming up somewhere in Delhi region, in Ghaziapur and other places where there were methane emissions and all that, and the existing contract was it had ended. So any news on those particular contracts, or are they up for bidding? Because with the Delhi elections, municipality elections being over, are they again up for bids, or there is still some time in coming?
So not yet, because if you probably are aware that NCD had a change. In terms of earlier there were three different corporations. The unification of the three different corporations to one common NCD is something which happened middle of last year or middle of this year, 6 months ago or so, and then came these elections in which there is a significant change of guard. So the project is still in the drawing board stage, and they have not yet come up with. We are following the project closely. As and when it comes up, we will be one of the serious bidders.
Okay. Thanks a lot, and all the best here for the future.
Thank you.
Yeah.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Ravi Lodka from Agarwal Investments. Please go ahead.
Hello.
Yes, sir, you're audible.
Yes, sir. Sir, I want to know, last quarter nearly 10,000 of RDF, and this quarter nearly 16,000 tons of RDF is there. So what will be the future capacity which company want to ensure?
Double. Yes. So, for us, production of RDF is not the problem, because we definitely can generate or produce as much RDF as possible as the demand for this thing. So what I mean is the supply is not the constraint. But we are very optimistic that in the next financial year, we will at least double the sales of RDF quantity.
Okay, sir. Sir, last Concall, that is of quarter 2, you mentioned that CWIP is due to the Nashik project equipment purchase. It is not giving to the corporation, right? So it is to be included in asset. So is my understanding correct?
Sorry, which project are we talking about?
Nashik project, sir.
Nashik, the assets belongs to the company here. We don't have to transfer it to the client here. So these are the assets completely belong to the company's books. They will be sitting in your plant and machinery system.
So, sir, earlier you told that this is actually included in CWIP. So it is to be converted into assets and machinery?
Yes, this will be converted into assets in my books of accounts. So because we started putting them to use from December, so the balance sheet as of 31st of December onward, the CWIP will flip into plant and machinery.
Okay. I got it. Thank you, sir. And sir, one last question. If you can give EBITDA margin of each segment in presentation, then this will be quite useful for us.
I appreciate that, Mr. Doshi, but this is slightly commercial importance for us, and it's something that we hold on to it. So we will not be able to disclose segment-wise EBITDA margins.
Thank you. Mr. Lotka, may we request that you return to the question queue for follow-up questions. We'll take the next question from the line of Bhagwat from Prosperity Wealth Management. Please go ahead.
Good afternoon, sir. My question is regarding the income tax demand order received during this quarter. What is the amount of total demand as per the order of its impact?
Yeah, so we got an assessment order done for FY2021 where the total dues payable by the company was around 12.6 lakhs. The same has been paid under duress and the same has been disputed, and we will be contesting the same in the CIT appeals. So the total amount demanded and paid is 12.68 lakhs for the year. We have not yet received any other assessment orders over any other previous years from the income tax authority till now.
Okay, so sir, demand is 12.6 lakh, you are talking about.
Yes.
Okay, fine, sir. That's it, my question. Thank you.
Thank you. The next question is from the line of Ketan Chheda, retail investor. Please go ahead.
Yeah, hi. From the business updates that you share normally on a quarterly basis, we see that for the past 5 to 6 quarters, there is no increase in the volumes of CNT as well as the MSW processing from the existing projects. Could you throw some light on why is there no increase in these numbers?
So what has happened is over the last couple of quarters, the incremental business has been coming from sites like Varanasi and Jhansi, which are on door-to-door unit counts. So the tonnage doesn't get reflected in numbers. So despite the fact that you see the core operating revenue from CNT operations increasing, the tonnages doesn't go because we are built not on tonnages on all our sites, only on few sites. So the data which is auditable and that can be shared is only for those sites where our billing is on a tonnage basis. So that is one of the reasons why you see that the total tonnage information is almost flat trajectory despite the operating revenue from CAT increasing. So we see, unless the contract specifically tells us that bill me on a tonnage basis, I will be able to add that to my reporting number.
Okay. The other question is on the EBITDA margins front. There is a trend of the margins going to the past 3 years. So what is the expectation going forward? Do we look forward to increasing EBITDA margins in the future?
So Ketan, over the last 3 years, the proportion of revenue from contract, which has a lower margin business, has been increasing significantly. So that is one of the key drag on my reported EBITDA margin. So as and when the construction phase of my Pimpri-Chinchwad waste to energy gets completed, I would only after that will I be able to see an upward swing on my margins happening because of the absence of this contract revenue, the same being reflected by increase in actual core processing revenues. So that will be my tipping point, which will be in FY24 onwards.
Okay, understood. And another question I have is, to one of the previous participants' questions on the new projects adding revenues. You mentioned that about 100 or 120 crores will be added. Did I get that number right?
Yeah, that is right. Over an annualized number. Now, they will not come from Q3 or Q4. They will be an annualized number which can come either from Q1 end onwards or from Q2 onwards. Because my Pimpri-Chinchwad, for example, though we are commissioning end of Q1, it will not run at 70% or 80%. We want to start it around a 40% PLF. So it's a ramp-up period. So we'll not see the entire 100% of revenue recognition in the very first quarter from that particular site, for example. But on a steady state, after everything being normal, 160 crore of annualized revenue is what we can expect from these 4 contracts that we have backed.
Thank you, Mr. Chheda. May we request that you return to the question queue for follow-up questions. We'll take the next question from the line of Harshal Patel, retail investor. Please go ahead.
Yeah, hi, this is Harshal here. So, would like to understand that why we are not presenting segment results, because it's very difficult for all of us to understand from which segment we are getting how much margin. That is first question. Second question is on that why we...
The audio is unclear from your line. Please use...
Yeah, just a minute. Hold on. Hello? Hello?
Yes, sir, please go ahead.
Yeah. So I wanted to understand that why we are not presenting segment results, because from each of the business, we are getting different margins, right? And as per Indian accounting standard, we have to assess the segments from the perspective of Ind AS 108. So first question is on that, why we are not presenting segment-wise results, first thing. Second thing, why we have not disclosed the amount of income tax demand, amount of income tax demand into the results. That is second question. Third question is on the expected credit loss on disputed receivables. Because we have few disputed receivables, we are not making any adjustments towards the time value of money as per Ind AS 109. So these are various few questions which I would like the management to give some update or appropriate, accounting recognition and measurement principles when they are publishing results. Thank you.
Yeah. So going with your first question, we don't provide segmental information details for two things. One is the accounting standards clearly define municipal solid waste as a single section, so we don't have to provide any further breakup of the kind of work that we do. More importantly, this is of a very significantly competitive industry wherein if I were to give the collection and transportation and the waste processing business section margins openly, then my ability to bid for new contracts and everything will be very much challenged, and it's in a public domain area, which is something that we would like to be governed against. So that is something that we are looking forward very acutely. On the income tax question, sir, we have just reported the numbers that have been informed to us by the income tax authority. They have neither claimed nor sent orders nor any assessment orders saying that this is the expenses that is being doubted or asked for. So as and when we get information from the authority, the same will be disclosed in the numbers. And third, on the time value of the value or the receivable which is getting stuck or we are getting hobbled because of the delay in payment, the management is of the view that we would start making an expected credit loss for now and also hire or appoint an actuarial to help us identify the best way to go ahead and quantify this amount and have the same disclosure in the financials. We will definitely have that thing in our books, sir.
And add to it, when we are presenting other expenses, can we have these few line items like which is a major item of your other expenses, then expected credit loss, or any other line item which are major portion, where most of the companies are giving that breakup of other expenses in certain line item. So I would request management, if they keep on putting more disclosures, then it is better for the you as well as for the investors to understand from the face of the result itself instead of having or keep on explaining over the call.
Definitely, point taken. We will check with our auditors and our systems whether the same time can be disclosed, and if there is anything which stops us from doing that, we'll have that same discussed and we'll have that thing put out either as a schedule or as an annexure. We'll check and get back to you on that.
Thank you. Mr. Patel, may we request that you return to the question queue for follow-up questions. Thank you. We'll take the next question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah. So, do you have any estimate on what are the carbon credits that we have accrued so far in the last 3 to 4 financial years? And what is our view on the carbon credits that are going to now accrue to us on these various projects? Do we get any part of it, or it will go directly to all the municipalities? And are we renegotiating contracts on this, because in future these carbon credits will get very valuable?
So surely, carbon credit definitely has come back, has made a comeback. So in our Kanjur project, all the carbon credit revenue, if at all it comes, will accrue to BMC. The only project where we have a substantial stake in the future carbon credit revenue is PCMC waste to energy plant, where 90% of the revenue will come to us and 10% will go to PCMC. So there is something which will happen only after the project is commissioned. So we have already started talking to a few companies to work with us on assessing this revenue.
And sir, what are the number of, can you give a quantum as to how many tenders we are now going to bid in the next 6 to 7 months? The value of tenders that we have bid for?
If I had to give a broad number, probably 3 to 4 tenders is what we plan to do, especially large ones. I'm talking only the large ones, not the routine ones. The real big ones, would be about 3 to 4 in the next, I would say 3 to 4 months. But other than that, we are also actively looking at some of the non-municipal revenue projects. The kind which, like Mr. Hawar mentioned about the end-of-life vehicle scrapping facility. So that is something which is like a merchant plant. So we are currently focusing on some of these non-municipal initiatives.
And sir, what is the kind of revenue that we could expect from this Bangalore this south-based city which you mentioned? Could it be like almost half the size of the Mumbai Kanjurmarg project that we are already having?
Sorry, are you referring to the Bangalore project?
No, you referred that there is a south-based city contract that we may bag, which could be a very big one. So would it be commensurate to the Bombay Kanjurmarg project, or it could be much smaller?
So this is actually a CNT contract. So strictly speaking, you should not compare it with the Kanjur facility, which is a processing facility. But yeah, significantly larger. One of the larger projects this will be one of our larger projects.
And do you see any kind of potential in redeveloping landfills which have been abandoned, like the Devnar landfill, and refurbishing the land in such a manner that it can be reused again for residential? This is also internationally a very big business.
So that's again a very interesting question. That's again a very interesting question.
There's also talk of the Mulund dumping yard being made into a race course. So those could be like very big contracts for us. So are we tying up with somebody internationally to develop this kind of expertise?
That's a very interesting question, because this entire concept of biomining is I would say the jury is still out whether it is feasible to do that on a sustainable basis in most of our larger cities or not. Having said this, we are very careful that whichever biomining project or so-called redevelopment of landfill project that we talk about, if we take up, we have to be very, very clear about the revenue model. Most of the projects, biomining projects, are not commercially viable. So we are doing one such project in apart from the Kanjur project, we have one such project in Greater Noida. We decided to take that up only because it was financially viable. So even going forward, we will be taking up these biomining projects only if the tipping fee rate is viable, and the revenue from sale of RDF makes business sense.
Okay, thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I now hand the conference over to Mr. N.G. Subramanian for closing comments. Thank you, and over to you, sir.
Thank you all for taking time out and attending this earnings call. We hope everything is we have tried to answer as much of your requirement. We remain confident that our long-term focus on our sustainable growth methodology and enhancing focus on the circular economy, transforming our business through technology, and trying to use as much automation as possible will help us in meeting the changing needs of our clients, our customers, and the people that we work around with. I hope we have been able to address all of your queries. For further any information that you need, please try and get in touch either with me or with our investor relations advisors, Prateek or Jigar, strategic growth advisors. Thank you.
Thank you. Ladies and gentlemen, on behalf of Antony Waste Handling Cell Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.